Welcome to Dollars and Cents with Freedman Financial, the home for financial advice in a language you can understand. Created by Marc Freedman of Freedman Financial, he and his team of certified financial planner professionals will discuss timely topics that help individuals and families make smart financial decisions. And now, get ready for this week's edition of Dollars and Cents with Freedman Financial.
Welcome back to another edition of Dollars and Cents with Freedman Financial. My name is Marc Freedman.
And I'm Christian Karcher.
And we're here to provide you with some financial advice in a language you can understand. We're excited to have you with us today, Christian. Marion is off on vacation, and so it's you and me giving the financial advice today.
All right. It's like I never left.
That's right. And so, because Christian's joining us, I let him pick the topic. So,
That's right.
So what is the topic we're going to be on today?
So I thought it would be interesting to talk about what I would dub water cooler personal finance.
Ooh.
So this is what you hear around the water cooler at work. People talking about their own financial decisions, people making suggestions maybe with maybe not the best information, or making really broad generalizations. So these are things you hear all the time, but can lead to questionable or even detrimental decisions in your own financial life.
Yeah, we hear this a lot. A lot of prospects or even clients will come in and they say, hey, I was at work and my colleague told me about this, or I heard about this information, or their parents or their financial advisor or so-and-so said, or I heard on the news. And sometimes it's interesting information. Other times it's laughable. But perhaps you can give us an example of where we'll kick this all off at.
Sure. So the first one that I thought of was I was actually talking with some friends recently. And with it being the spring, a lot of the bigger companies pay out bonuses in the spring. And so people are talking about, oh, okay, you've got the bonus coming up. And people were talking about, do you turn off your 401k contributions for your bonus?
So let me be sure I understand what you're saying here is, because generally when you're getting your paycheck, you're automatically set up to have some money deducted directly from your pay, whatever percentage that is, but now you're about to get a big bonus check. Maybe it's a couple $1,000s, maybe it's tens of thousands of dollars, whatever it is. So you're saying, does someone for that particular check say, you know what? I don't want to put money in my 401k with this check. I want to take it all.
I want my whole bonus. That was my
whole thing.
bonus. How exciting. I'm going to use it to pay for vacation. The only problem is, now you're reducing how much you're contributing to the 401k, and which might be okay, but what you are giving up is the match on that bonus in a lot of cases. So in a lot of cases on a 401k, your employer will match a certain portion of your contribution. Let's just say they match the first 5% of your contribution. If you're doing that on every paycheck and you're getting your full match, that's great. If the bonus comes around and you've got $20,000 of income, and you say, okay, I'm not going to put in that 5%. You're giving up that 5% match on that bonus money.
Yeah, so one of the things to consider here is this is still an it depends answer.
Absolutely.
Because there could be an instance, depending upon, and I'm making some generalizations here. If you're the person or employee that's hanging around to the water cooler, chances are you are not maxing out your 401k contribution. Chances are you're not in a position where you're putting in, what is it, the maximum is what, 28?
Yeah, it depends on the age.
Depending on
yeah,
the age or whatever, $28,000, $30,000. So, sometimes if you're getting a big bonus, let's say you're making $300,000 a year, using that as an example, and you get this big bonus in April, you could actually max out your 401k if you contributed to your bonus and do it too early, if you want to call that, instead of stretching it out. But if you're not going to hit the number, the full number through the course of the year, maybe it makes sense to have money coming out of the bonus.
Exactly. And I think you bring up a really good point, which is the sad answer of it depends on most financial topics is...
People hate that.
People do hate it, but when you're talking in a water cooler setting, everyone's situation is a little bit different.
Oh my goodness.
There might be someone who's earning a little bit more money, and so they are maxing out that 401k, so they say, no, I don't make a contribution on the bonus. Well, they could be saying that very... with a lot of bravado, telling everyone this, and people might take that as, oh, that's the good thing to do. And maybe for their situation, it's not.
Well, I'll tell you, here's another water cooler thing that just popped into my head, is oftentimes employees are all participating in the same type of a 401k plan. And some people are looking at their 401k options more so than others. And it might be time to start, maybe the market's been off a little bit, or good or bad or sideways or whatever, and there's someone at the office who's looking at the performance numbers to see that a particular mutual fund in their 401k is up big for the quarter. And they're now encouraging everybody in the office, you got to get into this. You got to get into this. Look how good it's doing. Does that make sense?
Well, oftentimes not. Oftentimes the thing that's doing really well is something that might be more aggressive, or it might be something that's had a very short period of outperformance. And so people say, oh, let's throw a bunch of more money in it. But what we have often found with all of these different categories of investments is when one does really well one quarter or 1 year, that oftentimes there's a rotation. And the next year, you might throw a bunch of money into that one, but the next year it might underperform a lot of the other categories.
Right, and we always talk about the fact that past performance is not indicative of what future results are. And generally when someone's saying, oh, this fund is doing really well, yeah, it did well for the people that were invested in it before, not for those investing now perhaps. Because think about this, look at all of these big name stocks. They call them the Magnificent Seven, right? Whether it was Tesla, Nvidia, Apple, Amazon, all of those. They were doing so well for so long. And it wasn't until Nvidia or some of these stocks were up 100, 200, 300% that we're starting to get calls here in the office from people who have CDs that are coming due, who never even wanted to invest in the stock market, and now they want to buy these stocks. And then all of a sudden, well, we try to encourage them not to, but then all of a sudden you get a period of time like we did it earlier this year, where those stocks just got hurt really badly, really quickly. Now, that's not to say they don't come back, but the power, the impact of those stocks, people were buying at the top, and we've always been told, you don't want to buy high, you want to buy low. But people don't like to buy low, do they?
No, people often inverse that adage in their actual actions, and they'll buy high, and then when it goes back down low, they'll sell low, it'll come back. One of the most famous examples of this is a Boston-based mutual fund, which was the Fidelity Magellan Fund. Just a random fund. Many years ago, it had a really good track record over a long period of time.
Peter Lynch, then Jeff Vinnick, and all these others that came in and had a great run. Yeah.
But the stat was the average investor in that fund lost money over that set period of time.
And why would that be?
Because every time it went up and it had the good performance, people threw the money in it. And when it had bad years, it was worse than some of the other funds that were available, and so people pulled the money out when it lost money. And so even though the fund continued to perform well, the average investor in the fund did not see that performance.
You know, so speaking of this quick in and out thing, so the Wall Street Journal this past week did this picture of presidents going back the past 50 years. And it showed what has been the stock performance of the first 100 days when each president was in office. And it was really interesting to see actually the best performance over the period of time that they showed was President Trump's first session in office when he came in, what, in 2017. His first 100 days, it had wonderful performance. Now, there's a lot of other presidents that had good performance, but he had the best of the group that was there. However, for this term, the past one he's in now, worst performance over the past 100 years. And I'm looking at this and I'm thinking to myself, this is what people are talking about. See, you don't want to invest in the stock market now because look how bad President Trump's 100 days have been in office, or any other president along this time. And my response to that is, who invests for 100 days? If you're an investor for 100 days and that's how you're judging the success of your portfolio, you're not investing, you're speculating. And that's one of the things that people talk about all the time, about how good they did this quarter or this month, or look how much money I made this week. That's not what investing's about, is it?
No. Investing is about the long term. It's about how much we have been able to build over many decades of saving and investing and growing.
And I think it's wonderful that we can actually show our clients upwards, for those that have been with us, we can have 25 years of historical performance for those that have been with us due to the software program that LPL provides to us. And it's really eye-opening to so many of our clients to see that despite certain years they were up, certain years they might have been down, on average over 5 years, 10 years, 15 years, 20 years, the aggregate performance is satisfactory in many cases to what they were looking for. It's within the scope and range that we had hoped. Of course, there's always situations where that's not the case, but generally many investors, as they look to a long-term portfolio, they are more and more likely to hit the average, the middle of the road, what we're expecting over longer periods of time. What happens in the first year, first month, first 6 months, even 3 years? No one knows. That's beyond our control.
And one of my favorite things about those reports is we've got this pretty little graph that shows the value over time, over
Right.
that 25 years.
Yep.
And you can go back and look at all of the big events that were earth-shattering. This time is different. This is a crazy situation. And you'll see they're kind of little blips, or they're longer.
They
profound,
felt significant
but-
at the time.
But it felt like the world was crashing down around us, whether it be the pandemic, whether it be 08, 09. I like to show the even smaller ones that you almost can't see. When I was about to graduate college, I'll date myself a little bit here, 2016.
You're not that old.
The first quarter of 2016, there was a pretty significant correction.
Well, it was just because President Trump was coming into office.
Oh,
right?
I'm sorry,
Was
No,
it 20?
he was not in office
Okay.
yet. It was the beginning of 2016. There were some things with the oil prices.
Right,
No
right.
one even remembers the reason anymore. It was this little dip. But I remember when I was applying for this job, you and Marion had done kind of one of your not emergency, but kind of topical pods to talk about what was going on with oil and all these things kind of rinse out in the wash, and you look back over very long periods of time, and they were blips along the road. They were very real in the moment.
Always going to happen.
But as long as you stuck to the strategy, as long as you had options for where to pull money from, people turned out okay.
So is there anything else around the water cooler that people are talking about that you think off the top of your head?
So one of the other ones
Yeah.
that I often see, particularly water cooler, big company you're thinking about, are stock options and restricted stock units. These are complicated products for the most part, and people seem to have a very simple view of them and what makes the best decision. Everyone says, okay, you should do this with it. And that one is for sure a question that it depends.
It's always, it depends. But it's interesting you mentioned about the stock options and stuff. Whether it's stock options or maybe you have employee stock purchase programs that you're involved in, I can't tell you how many people come in and they find themselves with a significant allocation of their investment portfolio to their company stock. And our advice generally is you want to make sure that you trim that down a little bit. Yeah, it's okay to own some company stock, but it shouldn't be the driving allocation, because anything can happen with a stock. And it amazes me how many employees are worried that if they sold some stock that they own, that their employer would know about it and think of them differently, as if they're not valuing the company or they're not being loyal to the company. And that is far from true.
Yeah, that is not the case. They are not tracking your
They don't care.
$1,000.
They
here
really
or
don't
there.
care. Look, the only people whose stock sales are tracked are executives who have to report to the Securities and Exchange Commission that they intend on selling shares. But if you're anybody but at that very special level, and you'd know if you were there, if you want to sell your shares, all of it, some of it, a portion of it, do it over time for whatever reason, nobody cares, nobody knows. So don't let somebody try to drive or influence your decision to do one thing over the other. And if they are driving or influencing your decision because they know something at the company, well, that's called insider trading. And you don't want to be involved in that either.
Absolutely.
And that's what we call financial advice in a language you can understand. If now is the time for you to get serious about your financial planning or investment management needs, don't hesitate to give us a call. 978-531-8108. That's 978-531-8108. Or visit us on that thing called the World Wide Web. FreedmanFinancial.com. That's Freedman.
2 E's and a D.
Financial.com. You can go to the bottom of any page, put in your name and your email, and you'll get our free weekly newsletter that lands in your inbox every Friday at 10:30 in the morning. Or you want to learn more about what we do, Christian's background, the fact that he went to University of Wisconsin, what he does in the office. Yeah, I mean, you're very proud of that.
I certainly am. We've even had a couple clients and kids
Oh,
and
yeah.
grandkids attend.
They're all going
in the
there
recent
now.
years. So
That's-
I hear it's a hot place to be.
Well, because they see the success that he's had out of University of Wisconsin, as his wife as well. And that's going to do it for us this week. Have a wonderful week, everybody. We will see you again next time with more dollars and cents and financial advice in a language you can understand. Have a great day.
During today's episode of Dollars and Cents with Freedman Financial, your host may have discussed specific financial planning and investment ideas that are for general information only and not intended to provide specific advice or recommendations. Please remember that investing involves risk and may include loss of principal. Always consult a certified financial planner professional, qualified attorney, or tax advisor prior to investing to determine what is appropriate for you. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA, SIPC.